I'll introduce Brian shortly, but first we really must thank a couple of people for making this happen. So particular thanks to Sarah Wallace from Agriculture Victoria that introduced us to the initiative of the Farm Business Boot Camps, which are a great opportunity for farm businesses to learn some skills around farm business management. And as a result of that initiative, that was also a big part and due to Jennifer Zapier from up near Mildura, a great producer up there who initiated and motivated Agriculture Victoria to move into this space in that Mildura area. And this is a flow on from that, so an opportunity for those people who attended those, but also on behalf of Agriculture Victoria, opened up to anyone with an interest in the region in farm business management, and in this case, particularly about risk management. So we hit 12:30, so we might kick off. People will continue joining in. So my name's Gavin Beaver. I'm an agriculture consultant based near Bendigo. I've been working in the field, I guess, for 30 years now. So time flies when you're having fun. Initially with the agriculture departments as an extension officer, and then since 1997 as an agriculture consultant. And I was contracted through Agriculture Victoria to deliver the Farm Business Boot Camp to the Mildura area, which was, as I say, hosted with Jennifer Zapier. I might at this stage introduce Brian, our guest speaker, who's going to speak about risk management. So Brian has been working also in the field for over 30 years. Brian has an agricultural degree, but he's got an interesting blend of skills and experience in that, along with his agricultural science degree, he also has a degree in education, so postgraduate qualifications in education. And he also has postgraduate qualifications in business accounting. He's a chartered accountant. He's a fellow of the Taxation Institute of Australia. He's a financial planning specialist accredited through ICA, and he's also a self-managed super fund specialist advisor. So he's got a unique range of skills and experience that he's been using with his accounting practice and in his farm business management advice right across Southern Australia and into Western Australia. And he's also, some of you may have come across him before because he's a regular and popular presenter. But his information he's going to share with us today is very timely, and not that farm business management is never not timely, but I think it's interesting times, and the particular emphasis that Brian's going to speak about risks and the use of FMDs is really important. So we hope you pick up some skills, or even if you're experienced in the area, some additional tips and thoughts and reflections that you can use in your farm businesses. So without further ado, I shall introduce Brian. Now in the chat box, you're quite welcome to use that chat box at any stage throughout to ask any questions. And there'll be a Q&A down the bottom as well. So you can use a Q&A panel if you wish to place a question in the panel. Brian, if you'd like to introduce the topic today, and then I might start with a short poll of everyone.
Thanks very much, Gavin. Yeah, no, look, it's a pleasure to talk to you guys today. This is an area that we're very passionate about, and we think that it's one area that has been generally overlooked in general farm management and accounting areas. So it's just a different way of organising people's thoughts and processes and strategies to assist them in achieving their life's goals. And it doesn't really matter whether you're a small farmer or whether you're a big farmer. All of these areas that I'm going to cover have just as much impact. So do you want to go ahead with that poll, Gavin?
Yeah, we'll just kick off with a bit of a poll. So just for some context for all of us. So you've already answered some questions there. So how many years have you been farming this profession? So we've got 80% at 0 to 5 years, and that's really our target audience in many ways. And a person here with more than 15 years experience. So I guess the idea of the boot camps and its follow-on information opportunities to give some networks and information and skills and access to people like Brian and other people into people that are working in farm businesses and building up their professional skills. Now, this question about do you have a plan? So it's really a plan of any type, really, but it doesn't have to be the hard and fast, plan that's in a folder or whatever it might be. But if you have a way of strategically thinking about your business, so if you think about strategic, tactical and operational, so strategic is that, what are we trying to do with this business? Tactical is what are the perhaps annual type plans that we might have, whether that be a cropping program or whom we're going to employ as casual labour at peak times, those tactical decisions, whether we're going to buy a truck this year. And then the operational ones are our day-to-day things. And we go between all three areas in running our farm businesses, and Brian will speak about that. So we have confident 20% of the people, and then 80% of the people not too confident in their current planning approach. So that's really useful that Brian is the right person for the job to discuss some of these things, but we hope will give you some greater confidence about the strategies that you have to call upon, or the tactics that you have to call upon to help with your farm planning. And currently we have one person using FMDs so far, and 4 people saying they haven't used FMDs. So thank you, Brian. I reckon that's good context for us all. And let's lead off, and hopefully we give people that extra information that they can use some of these tactics and strategies going forward.
Excellent. Thanks, Gavin. So I suppose the first place to start is with our disclaimer. Basically, people will be introduced to a number of different strategies and ideas, and we urge people before they adopt those ideas or strategies that they at least seek some professional advice. We don't take any responsibility if anyone takes on anything that we suggest without them at least consulting with someone who's qualified in these particular areas. So I suppose this is all about farming, as we would assume, and farming's about people and people using farm assets like land, plant and equipment and things like that. And there's basically a number of different decisions, and in fact farming is all about decision making every second of the day. And one of the main reasons for that, of course, is that people are dealing with the climate and nature and things like that, which makes these decisions very, very important. And we've sort of classified these decisions into production decisions, financing decisions, and cash management decisions. So, and of course, one of the keys to any form of financial success is that you actually make the right decision on the right day. And it's probably just as important in farming to make the right decisions with the money that you generate than it is the decisions that are involved in generating that money. And the reason why I say that statement is that a lot of farm management focuses around with production, efficiency, generating money, but not a lot has been concentrating on what people should be doing with the money once they earn it. So one of the key things in farming relates to emotion. The main reason being is there's a very distinct relationship between the decisions that people make and the way they're feeling. So if someone's a bit off colour, they suffer from a mental health problem, they've had an argument with their wife, they're under financial stress, it really does affect the decision making that they do on the day. And it's, as I said, it's all about decision making. And if you make the wrong decision on a day, it can have an effect for years to come. And we see this where people are having a relationship breakdown. They run generally a profitable property, have done for years. All of a sudden, the profitability of that property starts to wane away because of the decisions they're making. They may fail to spray radish on a particular day and then have an infestation. They may forget to put the ewes in or the rams in with the ewes on the wrong day. So each of these decisions can have a knock-on effect for many years to come. And as I said, farm management generally concentrates on the generation of profits and efficiency. And there hasn't been a lot of attention on what to do with these profits when it comes to reducing risk and generating wealth. So to do this, you effectively need to have a farm business plan. Now, I've been working in this field for about 35 years. And when I used to go around speaking to farmers, I'd say, you know, do you have a business plan? Most farmers I know don't have much of a plan at all. And the reason being, they're faced with a lot of uncertainty and risk. You know, why go to the effort of putting together a great detailed plan when you can run into a poor season or a bushfire or commodity prices where the Chinese decide not to buy barley that can actually wreck the plan entirely. And one of the things that I noticed was the emotional impact this had on people of various generations. You know, I've seen lots of farm planning sessions where consultants come in and get everyone to write down their aims and goals and what they want to achieve on bits of butcher's paper, and they stick them up all around the walls and all that sort of thing. And they put together quite a detailed plan, only to find that they run into 2 or 3 years of drought. And Dad says, well, you know, we'd like to follow the plan through, but unfortunately, we're just going to have to pull our belts in and live on bread and dripping for a couple of years. And the effect that that has on people is quite dramatic. And that in turn, as I said, affects their emotions. And when their emotions are affected, it affects the decisions they make, and that affects their profitability. So, of course, in farming, we're all faced with a whole range of different risks. There are things like production risks, market risks, financial risks, taxation risks, family risks, cash management risks, and there's also the risk of making a poor decision on the wrong day because of the carry-on effect that that has for years to come in regards to productivity. So, way of getting around this is that you can make the right decisions at the right time, but we know that that's almost impossible because we're all human creatures and we're all dealing with various people in our businesses. Or if you can't do that, you've really got to develop the right strategies and plans to mitigate and manage these inevitable risks, because whether we like it or not, they're going to happen. You know, I speak to a lot of farmers who say, oh, well, you know, we're not in a very good financial position. It must be to do with the bad seasons we've had. And I look at them and say to them, well, it had nothing to do with the bad seasons because they're always going to be there. It was the bad decisions that you were making during those seasons. So we eventually decided that we had to come up with a way in which people could formulate a strategy of developing a plan, with a plan that wasn't so fixed in stone that it couldn't be changed depending upon the circumstances. And I always remember a story out of the, I think it was the New Testament, where they talked about, you know, building a house on sand and a storm coming along, and all of a sudden the walls of the house started to crack and the whole house fell down. And the importance of having a solid foundation upon which to build the house so that no matter what you threw at the house, it would stand the pressure and the risks of time. And that might involve, you know, poor seasons. It might involve a family divorce. It might involve an unsudden and unexpected death. It can affect all sorts of things. So we've come up with a process which we call our 10 tools in the shed. Now, when it comes to tools, as you would all be aware, it's not only a matter of just having the tools, you really need to know how to use the tools. Now, if you went and saw the dentist and you walked in there and he had a chisel and a mallet, you would be particularly concerned. So having the right equipment is absolutely essential. And I say to people that, you know, farming is a bit like a game of chess. And that's why I call this the farm business game. You know, some of you may have played chess, some of you may not have, some of you would be aware about chess, but in chess you have a number of different pieces and each piece moves on the board in a particular way. So I used to play chess against very clever doctors and engineers, and we'd start off with all of our men lined up on our chessboard, and I would know all of the pieces and I'd know how to move them. But within a matter of about half an hour, I would always lose. And I suddenly realised it's not about just having the pieces, and it's not just about knowing how to move them. It's all about strategy. It's about having a plan and a strategy in place. And that is absolutely critical. So when we do a review of a lot of farm businesses, you know, we see that they have a number of structures in place, and they have the right finance in place, and they use equipment finance, and they use this and that. But the thing is, 99.9% of the time, despite the fact that they have the pieces and they know how they work, they themselves aren't using them in a strategic manner. And that's exactly what I'm talking about today. So what are these magical 10 tools in the shed? Well, the first is that people need an appropriate operating structure. Now, what we're talking about here is that there are a number of ways in which people can trade. They can trade as a sole trader, in a partnership, in a company, or a family trust. Now, each of these particular structures has an enormous impact on how people manage their income tax, how people manage their succession or transfer of ownership and control from one generation to the next, how they protect themselves from risks such as, you know, being sued because you created spray overdrift, or a bushfire, or what happens in the event that someone dies. So actually understanding different structures and working out whether they're appropriate for your needs is an absolutely essential tool. You can't just rely on your accountant to say, well, this is how you should trade. You should really know why you're trading the way you are. And the next step, or next tool in the shed, is how you own assets. You know, you can own assets as jointly or in your own name. So if you own them jointly, then you can own them as what are called joint tenants or as tenants in common. Now, this has a big impact on how these assets are handled in the event that you die. For instance, joint tenancy means that the ownership of the asset reverts immediately back to the other person. Whereas in tenants in common, people can say in their will who they want their interests in their property to go to. And I think we need to understand in agriculture, a lot of it is about property and asset owning. Then, of course, you need the appropriate finance facilities. Once again, this is an area that a lot of people don't understand. They think they can just go down to the bank or take advice from the bank manager in regard to their finance. Banks are in business to make money. They make money from farmers. So although you may get on very well with your bank manager, the policies that he gets from upstairs may not necessarily be appropriate for your needs. So you need to start understanding about finance, whether a Rabo all-in-one facility is suitable for you, or whether you run an overdraft and then you have a principal and interest loan on the side, whether you use bank bills, whether you use equipment finance. Financing is a very important tool that you need to understand when it comes to managing your business. Then there are farm management deposits. And this is one of the areas that I want to expand on today, so that you can get some idea how each of these 10 tools can be used. Because within each 10 tools, there's lots of separate strategies that are absolutely essential for you when it comes to running your business. Then there's equipment finance and equipment purchasing. I have a belief that about 1/3 of farmers in Australia have a financial debt level entirely associated with acquiring plant and equipment. And there's a strategy that people have to employ, because you know, you guys are in a business that requires a large investment in depreciable plant and equipment. And I've got some examples today to just demonstrate that. Then I'm a great believer that people need a self-managed superannuation fund. Now, these superannuation funds are different from, you know, your AMPs, colonial first states, and your industry funds like CBUS or primaries. These are structures, it's a trust structure that you use within your business. So for instance, in my business, my superannuation fund owns my office in Port Lincoln. It owned half a sheep station on the Nullarbor. It owned a third of a crayfishing licence in South Australia, and now it owns a farm at Munglanup, which is about 120 k's west of Esperance. I've always used my superannuation in my business as a tool. I would much prefer to know where my money is invested rather than rely entirely on shares and cash and things like that. Not to say that shares and cash aren't important. I just think that superannuation funds are specifically designed for primary producers. Then I believe primary producers need to acquire off-farm assets. Once again, most people like to feel that they're investing in their business, whether it be equipment or land, but there is a need, and there will come a time later in life when you will need some off-farm real estate to provide for retirement housing and those types of things. So acquiring off-farm assets is absolutely essential. I have farmers that fund their overdraft at this time of the year by drawing down on the equity of their shares. It's called a margin loan. And while they have planted their crops and the crops are growing, they still own their shares and they'll still get their dividends in August. And at the end of the year, when they get their harvest proceeds, they simply pay off their margin loan, but all the way through the process, they've had an investment in another income earning asset. Preparing family agreements and having insurance to cover people for things like unexpected accidents and illness, and actually having an agreement within the family of knowing what is going to occur at various times should various events arise. This is particularly important for young people in farming families, but also for larger families where there are brothers and sisters involved in the farming operation. People need to have a clear succession plan. Succession is one of the most misunderstood areas involved in agriculture. Most people assume that succession involves someone getting old and someone retiring. But succession can occur as soon as you own something. And I say to my farmers, succession becomes a real issue for you when you hold your first child. If you have a second child, you've got a problem. If you have more than 2 children, you've got significant problems. And if you don't start planning for succession from the very first day you step foot on the property, you're going to have issues down the track. You can't do anything about that when you're 60. It's a bit late. And of course, everyone needs an appropriate estate plan. And that means everyone in the business, from the very youngest members of the family to the very oldest member of the family. And people need to understand how it works, what's necessary for them. So these are all of my 10 tools of the shed, in the shed. So the first one I want to really expand on today are going to be farm management deposits. And I really think, to do it justice, we're not going to get much further than that. As I said previously, the example I'm about to go through with farm management deposits relates back to all of the other tools in the shed. So each topic is quite a large topic on its own. And if possible, we might touch on equipment replacement and upgrade, but we'll see how we go. So farm management deposits, what are they? Why should I have this tool in my shed? Well, they were developed by the government many years ago, back in the 60s, and they were originally called income equalisation deposits. Then they became called farm management bonds, and now today we have farm management deposits. They're very popular, and people, primary producers, can put money into a farm management deposit up to about $800,000 per person, which for most of you will seem an extraordinary amount of money, but there is a reason for that. Basically, they are just a term deposit. So you go down, if you're a primary producer and you have to be engaged in primary production, and you can only use primary production income to make a deposit. So it's just like a term deposit at a bank. And the bank has to be registered with the government to take farm management deposits. The deposit must remain on deposit for in excess of 12 months, unless, of course, there's a natural disaster in which people can then withdraw their farm management deposits early. You can't have non-primary production income that exceeds 100,000. So this gets a bit touch and go with some farmers who have wives that are teachers or doctors or other vets and things like that. But if their non-primary production is less than 100,000, then they're eligible to deposit their FMD. You can't exceed 800,000 per person, and that was just increased in the last couple of years. In some instances, people can have an interest offset because, like most term deposits, the FMD will earn interest. And where you're structured correctly, that interest that you earn on your FMD, all being that it's very minuscule at the moment, can then be used to offset against a farm loan. And there are special rules that people need to know about for trusts. So when you make your term deposit, then, or this is what the government say, an FMD allows a primary producer to carry over income from good years of cash flow and to draw down on that income in years where they need the cash. So in the year that you lodge your farm management deposit, term deposit, you claim a tax deduction for it. And the year in which you redeem the farm management deposit, it comes back into your tax return as assessable income. And the aim here is it's designed to enable primary producers to defer their tax on their primary production income from one year to the next. So most people think that farm management deposits are there to reduce tax. It was our view that this is very one-dimensional, because our view is much broader. We started using farm management deposits, and then we started to realise just how critical they are for farm businesses, because without farm management deposits as a tool in your shed, it is going to limit your progress. And I'm about to demonstrate exactly why that's the case. Then when you talk to farm management deposits, including a lot of accountants, they're very critical. And they say, oh, well, they save tax in high income years, but you'll end up paying the tax anyway when you withdraw them. That's not necessarily the case if you have a strategy in place. Another problem that people have is that we never ever generate enough cash to ever accumulate 800,000 in FMDs. And that may well be the case. You don't have to accumulate that much. You can have $5,000 in FMDs. The effect can be just as good as having 800,000. And then what we discovered was that once we had developed the FMDs and we had a strategy in place, everyone wants the money back. They were all pleading to us, when can we get our FMDs back? And that's when we started on our educational campaign. And we said to people, you really need to think laterally about farm management deposits, not just procedural, get the deduction when they go in, pay tax when they come out, because you should never pull them out. But you have to learn how to use them strategically. So, how do people get started? You know, one of the problems in primary production is a lot of people can have assessable income in their tax return, but no cash. All that cash is invested back into equipment, it's invested back into crop or livestock inputs, you know, acquisition of stock, sucks all the cash out of the business. So you might end up in a situation where you have a large assessable income, no cash, can't make a farm management deposit. Well, here's just a different way of thinking about it. You borrow some money from the bank. Now, provided you have security and land, the bank will generally lend you some money. So in this particular case, we lend 100,000, paying interest at 3.5%. So it's going to cost us about 3,500 in costs. You then make a deposit in the same bank of 100,000. Banks absolutely love this because they get brownie points for lending people money, but they also get brownie points for making deposits, because the government says that banks have to take deposit money in to lend it out. They can no longer just lend from overseas. Some of the money has to be generated in Australia, so deposits are very important for banks. And in this particular scenario, you're lucky enough to get 1.5% on your FMD. and you're going to earn 1,500. Now, from a balance sheet risk point of view, you're square because you've borrowed the money. It has to be on deposit. You can't spend it. It's got to be in the bank. So there's absolutely zero risk involved in doing this. The cost to you is $2,000, right? That's the difference between what you earn and what you have to pay as interest. But this is where it gets interesting. If you're paying tax at an average rate of 25%, you get a $25,000 tax reduction, right, or deduction. And so it's the 100,000 is the deduction, 25,000 is the actual cash savings, less the 2,000 it cost you, you're better off by 23,000. Now, I have guys who have done this for 800,000, and you start, and then if there are multiple members in the family, all of a sudden you can have lots and lots of these farm management deposits and lots of tax savings. Now, needless to say, if you were to withdraw the farm management deposit, you'll end up paying the tax. But we noticed a very interesting thing. Whereas people started with an overdraft, after a period of time, if they ran a successful business, their overdraft got back to square and they still had their farm management deposits. And this is when people really start getting going with this strategy. I say to people, if you're a primary producer and you're paying tax and you haven't maxed out your farm management deposits, you're basically getting the wrong advice. So, what are the practical strategies with using farm management deposits? Well, the first thing is we believe it is the very first strategy we apply with our primary producers. If they come in through the door and they haven't got farm management deposits, they're earning assessable income and paying tax, we put the money into a farm management deposit. The reason for this is it becomes a foundation. Remember how I was talking about foundation that can underpin strategies. So say, for instance, your plan was to put $25,000 a year away in superannuation. Now, if it goes into a super fund, it can get locked up in there because of preservation and not being able to access it until you reach a certain age. Why not put the money into an FMD? Because you can always get it out. So it just becomes a plan. And remember when I was talking about those young people who would come up with a plan and then all of a sudden they'd come across some adverse event and they'd have to stop doing that plan. We see farm management deposits as being the base of all of those plans. So we also see them as a strategic form of savings. Unfortunately, in our new modern world, savings seems to be something that's been forgotten. Very few people are savers, and primary producers are classics. They'll struggle along for years, and then all of a sudden they'll have a good year, and for some unknown reason, they can't help themselves but give everyone else around the place their money, whether it be acquiring new equipment or whatever. So we see farm management deposits being a really valuable form of savings with a bit of a kick on the side that you get a tax advantage. But it's very, very important to have money set aside for uncertain risks. You know, last year when we were having a bad drought, and then lo and behold, in August, we had these massive frost events. You know, the amount of people that rang me up to thank me just to say, you know, we've had a complete wipeout here, but thank God we've got those farm management deposits because we know we can continue with our plans and we know that we've got money to put in next year's crops. You know, a little bit of saving along the way never went astray, trust me. And FMDs are a classic way of saving money and getting a tax advantage along the way. Then we had all these people asking us, you know, we've got all these farm management deposits. They're now currently paying us anywhere between 1 to 1.5%. When can we get the FMDs out? And we said, well, why don't we start using this as a positive overdraft as opposed to a bank overdraft? So what we're talking about here is that once you've had money in an FMD and it's been there for 12 months, you can pull it out. So a lot of my clients this year will redeem significant amounts of their FMDs in July. And they will actually use that money in running their farm until we get to June next year. And then what they do is they redeposit them. And because the withdrawal and the deposit net each other out, there's no tax effect. So all of a sudden, these people are using a proportion of their FMDs in running their farm business. And when you get a significant amount, it then becomes like a positive overdraft. Instead of borrowing from the bank, you're just drawing down on your FMDs. And in a really low interest rate environment, which we're faced with at the moment, then it just makes common sense that you do that. Then we latched onto the idea of doubling up the deduction. So the first year the deposit goes in, stays in for 12 months. Then the second year, the crazy accountant comes along and says, well, let's make another deposit. And then we can fund that second deposit out of a redemption of the first deposit. And you can continue doing this for years. I've had people buy farms with the tax savings that they would have paid, or the tax they would have paid, had they not used FMDs. And we use this rotational effect for years to come. And some of them have had farm management deposits for 30 years. We use it as a provision for financial insurance for future events. This is where you borrow from the bank and you buy land or off-farm assets. If you've got $200,000 or $300,000 worth of FMDs tucked up your sleeve, you're in control of your financial affairs because you've got the right finance facilities, then you can quite comfortably go down and borrow and buy these assets, knowing full well that you can pay your interest and your principal no matter what happens in your business. This is really powerful stuff. And then in an emergency, the FMD can be withdrawn and the bank can be satisfied. We use it as the first step in any form of debt reduction. You know, we all know when you borrow money, you have to pay it back. But we're in very uncertain times at the moment. And I say to people, you know, if you pay all your money back to the bank, there's a good chance they might lend it back to you. You know, if you've got the facility, continue to use it, especially in this low interest rate environment. So why not start putting money into FMDs, claiming a tax benefit along the way as a provision for future debt reduction. When you get your FMDs up to a level that you're happy with, then you can start repaying the bank. Now, this particular topic is very topical at the moment because I think most people would be aware with the COVID-19 stimulus packages that are out there that there's all these depreciation allowances or tax deductible claims that people can make when it comes to acquiring plant and equipment. There's two main packages. One is the instant asset write-off, which was $1,000 per annum, but it's now $150,000 per annum for new and second-hand assets that are acquired and installed ready for use on the property. Now that was to go to the 30th of June 2020. This morning I noticed on the news that it's now been extended to the 31st of December this year. So it's been extended another 6 months, which is really interesting because that is if you buy a second-hand asset or a new asset up to $150,000, you can write it off. You can buy more than one and, you know, get a $300,000 write-off if you want it. The other package relates to new equipment. And this is where people buy new equipment. They can get a 50% immediate write-off. So let's say the asset was $600,000 seeding machine. They can get a $300,000 tax deduction. And then the other 300,000 gets depreciated over the normal life of the asset, either under the small business depreciation pool, where you claim 15% in the first year and 30% thereafter, or under the uniform capital allowance provisions. So this is an incentive to get primary producers to spend money on plant and equipment and also to save tax. So this example is how you use farm management deposits in the strategy. So if you wanted to buy a tractor for $225,000 and your tax rate was 25%, how much tax do you think you'd need to pay? Well, you'd have to earn $300,000 to start with. It'd have to be available cash. You would pay your $75,000 in tax in March to May the following year, and that would leave you with your $225,000 to acquire the tractor. Now, as you can see, that used to be the old depreciation rate. That has now changed because of COVID-19. Needless to say, under this strategy, 300,000's walked out the door. Not a lot of people have a lazy 300,000 sitting around. So here's an alternative option. What you do is you take your 225,000 and you put it in an FMD. That will reduce your tax by 56,250. So instead of your tax payment the following year being 75,000, it's now 18,000, a significant savings. But what you do is you go down to the bank and you borrow the money on what we call a chattel mortgage or an equipment finance contract. And they fund the asset for you. Now, your annual payments on that equipment finance, paying it straight out, is $63,000 a year. Now, you would only acquire this item of equipment if it was necessary in your farm operation. And hopefully, if it's a profitable operation, then there should be no problem meeting the $63,000 a year. However, if you ran into a problem and there was no profit in your business, you always know you can go back to your FMD and withdraw your FMD. The concept here is a no-risk concept. You know, you're getting a depreciation deduction for your equipment, especially during this period of accelerated depreciation. Sure, you're borrowing the money and that comes at risk. But what you don't understand, or what you need to understand, is that if you deposit your farm management deposit, then there is no risk. You can always meet your equipment payments and you actually get to use the machine that you need in your business. Now, this is particularly important because I went and saw some farmers some time ago, good farmers, and I said to them, I was a bit of an idiot, really. I said to them, I don't think you're running your business correctly. And they said, what do you mean? I said, well, you've had a series of good years and you haven't paid anything off your debt and you haven't purchased any farmland. You've just, you know, nothing's happened. And they said, that's terrible. They said, well, look at that down at the shed. We own all of that equipment down there. And I sort of looked them in the eye and said, guys, you know, all that investment, all that cash in that equipment, that stuff depreciates. And in 5 years' time, it'll be stuffed and you'll have to trade it in and buy new stuff. You should be investing your cash into land or reducing your debt, not putting it into plant and equipment. Well, they threatened to change accountants, and I said, well, you guys should think about this for a while, which they did. And then eventually they came back, and now they have a nice balance of farm management deposits and equipment finance. They still have all the equipment they need to run their farm. They still have the newest and the best, but they don't own it. They've financed it correctly. So farm management deposits are absolutely critical when it comes to acquiring equipment. And we won't let farmers do it if they haven't got farm management deposits. Then there's this old chestnut, where someone's providing for their retirement. If they put their money into their super fund, well, of course, it gets locked up. But if they put it into farm management deposits, then they can either pull it out and put it into the super fund, or they can put it straight in from the farm management deposit. Now, I had an interesting experience last year where a farmer of mine who's retired was in Broome, and he was at the caravan park, and he rang me up 4 o'clock that night and said, I think we're in trouble. And I said, why is that, Jim? Why do you think we're in trouble? And he said, well, I've been down at the caravan park having a few beers with the boys around the barbecue, and they said we can't have farm management deposits because we're no longer farmers. And I said, look, Jim, it's as simple as this. To own farm management deposits, you have to be a primary producer. You have to grow crops, you have to tend animals, or you have to be an eligible beneficiary of a primary production trust. Now, it just so happened in this scenario, Jim's son and his daughter-in-law were continuing farming, and he and his wife were beneficiaries of that trust. And as a result, they can continue to hold farm management deposits despite the fact that they're driving around the country. Now, in their particular case, they can withdraw up to $30,000 each in cash out of their farm management deposits, and because of their age and the marginal sliding or average sliding tax scale, they can withdraw that $30,000 each and never pay tax on the amount. So as a result, these guys many, many years ago got the deduction. They carried that deduction forward through that strategy that I demonstrated earlier. And when it comes to retire, they can draw down their farm management deposits each year by migrating them into their super fund, or they can just live on the cash. They never, ever get to pay the tax. So when you think about that, and you think about some of those criticisms that I raised earlier, maybe people should start thinking a little bit differently about these things. Now, you would have all heard about gearing. Now, gearing is, the terminology comes about because gears in a car. If you went into town in first gear, it'd be a slow process. So you have second, third, fourth, and in some cases, overdrive in your car. Reason why, when it comes to borrowing, gearing's terminology is used is that what you're doing is you're borrowing to buy a capital asset quicker than if you went around in first gear. So if you think about it with farm management deposits, if you're going to borrow to buy assets, as I demonstrated earlier, and you've got your farm management deposits tucked away on the side, they're a bit like having a turbo thruster on your gearing, because you've got this financial insurance up your sleeve. So you can get really, aggressive with your borrowing, knowing full well if you're buying quality assets that are going to go up in value, you've always got your FMDs. So I term FMDs as turbo thrusting your borrowings. And my goodness, the amount of wealth I've seen people generate using this strategy at very, very little risk. Very little risk, because if you've borrowed the money and you've got a term deposit in there, it's a no-brainer. This is just common sense. So, and finally, the 10th reason why I believe people should use farm management deposits is the tax savings. They are a very useful way of reducing tax. And as I said before, if you're a primary producer, your income, your non-primary production income is less than $100,000 a year, and you are not using farm management deposits and you're paying tax, there's something not quite right in what you're doing. So farm management deposits are really, really essential. Now, we have people, we farm in semi-marginal areas, so we have a lot of droughts. So we're often asked questions about when should we withdraw our FMDs? This is quite critical for some people this year. It is every year, because my practice goes from one side of Australia to the other, so there's always someone having a drought or a frost. So we've had our farm management deposit that's been in there for 12 months. We've had our drought. We could, and the bank are suggesting to my client that they withdraw their farm management deposit to fund this year's crop before the 30th of June. Our preferred option is not to do that. Our preferred option is to get some temporary funding in place, maybe for 2 or 3 weeks, to actually push the redemption into the next financial year, because then these people have the opportunity to repay that FMD before the end of the financial year. Now, if you look at this from an income tax point of view, if these guys had withdrawn their farm management deposit then, it would go in their 30th of June tax return, and they would have about 11 months where they'd have to find the money to pay the tax because they didn't redeposit the farm management deposit. If, however, they left that redemption a few days until the following financial year, not only, and if they don't redeposit, then they've actually got they've got 22 months, 2 seasons in which to earn money to pay the tax on the FMD. But if, by the grace of God, they have a successful second year, they can always redeposit and there's no tax. So I suppose what I'm trying to demonstrate here is that it's very, very important that people have a strategy. You know, this is not just about having a high income year and going to your accountant and the accountant saying, put money in a farm management deposit, and you thinking, oh, I wonder when I can get that back. That's part of it, but that's the one-dimensional thinking. You start thinking strategically. You start thinking, how can I lay my foundation stones so that I can put in place plans, I can upgrade my plant and equipment, I can take advantage of some of these tax incentives we've got at the moment, which, if you're in a family trust or a partnership, you can carry forward to future years. But how do you do it without much risk? Well, it's a very simple, it's plain as the nose on your face. You have to have farm management deposits. And when I say to people, they tell me, well, the Vikings have come, they've burnt down the village, they've killed all the men, and they've run off with all the women. Should we withdraw the farm management deposits? And I say, no, they're only there for a disaster. So, key elements for a farm management deposit. You need to have primary production income. You need to have flexible finance facility with land equity so that you can get your farm management deposit strategy started. And before you start, you need to have a structured strategical plan. You need to know what you're doing with them. If you're only using them to avoid tax, then more fool you, because they are more powerful than that. They should be part of your overall farm planning strategy. And of course, once you've got them in place, start buying farms. Set up a self-managed superannuation fund. Start acquiring off-farm assets. As I said, they are the foundation that everything else is built on. So when we're talking about farm planning here, we're not talking about budgets, we're not talking about gross margins, we're not talking about capital budgets. You know, what we're talking about here is we're talking about strategy. Remember how I started off talking about the game of chess, how you can have all the pieces, everyone knows how they move on the board, but that's not how you win the game. You win the game by having the pieces, knowing how they use, and having a strategy. And I hope today I've been able to demonstrate to you how just important these things are, and there's no risk with these things. This is, you know, you can sit down with an 80-year-old, very conservative person and sell this to them because they can see the common sense in saving. Financial risk is absolutely imperative when it comes to primary production, just as it is to grow your primary production asset.